Exercise 2-28, we're going to calculate the debt ratio. So Jason Hilton, medical doctor, reported the following trial balance as of September 30th. So here's our trial balance data. Now remember, a trial balance is just a list of all the accounts that have a balance, and then it lists each account's balance on the plus side of the account. So the order of the trial balance is always assets first, then liabilities, then our capital and our draw account, which we consider equity, and then our revenue accounts, in this case just one, and then our expense accounts. So I'll close that momentarily so we can see our instructions, calculate the debt ratio, select the debt ratio formula on the first line, and then calculate the ratio. So we're going to put the formula in words up here, and then we're going to plug in the numbers here. And notice, according to this percentage sign, they want the final answer as a percentage, so we have to convert it to a percentage. And it says, rounding rules in green, round the percentage to the nearest whole percent. All right, so our first task is we need to know what the formula is. The formula is total liabilities divided by total assets. So remember, assets are either financed by others, like the bank, which means liabilities, or they're financed by the owner. In other words, part of the assets are owned by the bank or others, and part of the assets are owned by the owner. So we're trying to figure out what percentage of these assets are owned by others, in other words, the bank. So we first need to calculate our total liabilities. So our total liability starts with accounts payable and includes utilities payable and then unearned revenue. Students often forget that unearned revenue is a liability. So refresh your memory, unearned revenue occurs when the company is paid ahead of time by clients for something that the company has not yet provided, either a service or a product. So because the company has not provided that service or a product, they owe that service or product to the customers. And when you owe something, that is a liability. And then we have notes payable, which is also a liability. So we have to add up those four. So we're going to add $1,800 accounts payable plus $700 utilities payable plus $18,290 of unearned revenue plus $77,000 of notes payable. Gives us $97,790. So I'm going to click into the cell under liabilities, hit the arrow, it shoots it over there so I don't have to risk mistyping it. Now we need to calculate total assets. So the assets are cash, accounts receivable, office supplies, office equipment, building, and land. So these are all things that the company owns and has a future value. That's the definition of an asset. So we're going to add up these. So we've got $37,000 cash plus $7,200 of AR plus $2,600 of office supplies plus $22,000 of office equipment plus $85,000 of a building plus $24,000 of land. Gives us $177,800 of assets. So now we have to figure out, of the $177,800 of assets, what percentage of that is financed, in other words, owned by others. So to calculate that, I shouldn't have closed my calculator. We're going to take this number divided by this number, and then to convert it to a percentage, multiply by 100, or just move the decimal over 2 places. So 97,790 divided by 177,800 equals 0.55 times 100 gives us 55%. So in other words, over half of the assets are financed. Is that high or low? Well, technically you need to compare that to other companies in the same industry. In other words, companies that are similar because companies in different industries have different levels of debt. Like utility companies usually have a lot of debt, whereas a software company usually does not have much debt at all. Then we check our answer, and that's it.